All right, welcome to the Multifamily Growthcast, hosted by the Multifamily Mindset. This is Tyler Devereaux here with Jackson Simmons Campbell.
That's me.
I just love your middle name, bro.
Dude, we haven't been here. We haven't been together. We haven't been able to record for a couple of weeks because of some traveling things. We had to do a couple episodes up front. So I'm excited, man. I love doing it.
Feels good to be back, bro.
It does, dude. It just feels right.
Recap the last drip, I think, was about business partnerships, which was a fun one for me to chat about, man. I loved that one. I loved going through the problem-solving system. If you haven't listened to that, go take a look, man. Go take a look, a listen.
Or look, it's on YouTube.
Yeah.
You can also
look
take a
at
watch.
how you can make changes while you listen. That's what I would do.
There we go. Take notes for sure. For sure. No, there was we kind of went off on a tangent during that episode about a problem-solving system, and it was awesome.
Sweet.
So if you didn't listen to that episode, definitely go back and listen to it and listen for that section because it really was super, super valuable.
Then when you grab something from it, what do they need to do?
You got to share it.
Share, like, rate, review, pay the price.
Yeah, pay the price.
All right, what are we talking about today, my man?
So today you just exited. Today we want to talk about you just exited out of one of your passive investments. Mm-hmm. And I want to talk to you today about how you screen those deals for passive investments, right? You invest actively all the time, but you also invest passively.
Totally.
So I want to talk about that. How do you go about identifying those passive investments?
Love it. Yeah, definitely, obviously, invest actively putting deals together, but dude, I'm always investing passively. In fact, I would say the far majority of my money, by far, that I have invested is in multifamily properties. It's the same thing that I do, just different properties. And I love this question because it's so important, man. Like, most people don't even know that they can invest passively into deals. I didn't, at least. I definitely did not know.
Right.
And so when I find out, I was like, shit, amazing. Let me throw some money into this thing. But I had no idea how to vet these deals, right? So I look at 6 different pieces. Okay, the operating partners, I learned that the hard way on my first deal. That's like the most important aspect, in my opinion. The operating partners. Who are they? What's their backgrounds? We'll get into some of those details, I'm sure. But also just the investment strategy of the deal. For example, let's say a major reposition, which is just a lot of construction, a lot of work. That's not a fit for an investor that has immediate liquidity needs. Somebody who a major reposition doesn't cash flow for a year or so, right. Maybe 2. So what's the investment strategy? What's my goals, right? Also, the market that they're investing in. I want to know some of the details there. The story of the deal, that's always important to me. Like why they're, the current owner is selling. What's the story? And does the story make sense? The business plan is number 5.
Okay.
And then just the underwriting. The underwriting projections are key too. Like, are they conservative? Are they aggressive? We can get into all these details as deep or as surface level as you want to, but in short, like, each market and each asset class they have a different strategy and it's unique. And so, like, as a group, as a Multifamily Capital Partners, our investment group, we focus on value-add properties,
right.
Value-add multifamily deals, right? And that's what I prefer as a passive investor as well. So value-add deals.
So you mentioned. The very first thing is operating partners. You want to look at that, and then you mentioned that you also learned in your first active. Oh, is that your first active investment?
No, first passive.
Your first passive investment. Yeah. You learned the hard way there.
Yes.
Why would you say? So you'd say operating partners is the number one thing you need to look at.
Totally, man.
Why?
So my first deal. So, and I'll say this too. I actually have a deal screening checklist put together.
Yeah.
That we can share. So we'll put that in the show notes and.
Sure.
Whatever we go through, it'll be way more detailed on that. That's for sure. So we'll put that in the show notes. You can jump in, download that, but it'll help you screen. That'll help you screen passive or active investments, I believe. So it's great. But my first passive investment that I ever did, you said I just exited my first passive investment, but that's not the first passive investment that I ever did. It's the first one that we've exited.
Sorry. Correct.
Passive side.
Yeah.
But first passive investment I ever made, man, I had no idea what questions to ask. No clue. I just was like, okay, these people have a deal, and I have some money that I want to put into a deal. So, what could go wrong,
Yeah. So what kind of questions are you asking when you're...
We'll get into it, dude.
Okay.
I'll tell you the questions that I asked.
Okay.
But, what happened is I invested in a decent deal in a pretty decent market with horrible operators, just bad operators. Real estate was booming, but my investment was, it was a bust. And, hopefully it will turn around at some point, but right now it's still not ideal.
Okay.
Have not seen a dime from any of that. So once again, I don't want people to make those mistakes, I learned that the number one factor behind deal performance are the operators behind it. There's going to be curveballs on every deal, right? Which means the operators better be experienced and dedicated enough to handle that kind of stuff. So yeah, operating partners are the most important in my opinion. What questions did I ask? Is that
that's what. How do you go about vetting those?
So questions I ask the operators when I'm on the phone call. Okay? First, what their background is. And hopefully they've sent me all this stuff before. Like I'll tell you very rarely the questions that I'll tell you. Very rarely does anyone need to ask us as an operating partnership about these questions.
Right.
Because we bullet point all of it in our property packets. You've seen those, obviously.
Yeah.
Because I know what their questions are going to be. How do I know what their questions are going to be? Because I've raised money on a whole bunch of deals, and I've been asked the same questions a million different times. And I've asked these questions.
And you're on that opposite side too, where you've been the one asking them.
So what's their background? I want to know how long they've been syndicating deals for. I want to know how long, the team that they're working with, how long have they worked together? How many deals do they own together as a partnership? What's the track record of those deals? How many deals do they own in that same market this opportunity is in? Is it their full-time focus or is it part-time? I want to know those kind of things for sure. Do they have somebody boots on the ground that live in the area to oversee the property management? What are they using? Property management, or are they the property management? What's their track record? We always show these things too. Like, hey, this is our average projected return.
Right.
What we project we're going to hit.
Yeah.
And this is our actual return. Right.
Yeah.
I want to know what their track record is. From what they've projected to what they've actually hit, what is it?
Yeah.
That's obviously telling. And then, are they investing any of their own money into the deal? I believe that question is super telling.
For sure.
Like, are they investing their own money? We invest in every single syndication deal that we put together because we believe in those deals? We believe in those deals. And also, man, we want to make sure that we're equally aligned with our investors. That makes decision-making so easy throughout the process because it's like, and trust throughout the process.
Right.
It's like, hey, man, we have money aligned and invested with you. Like, trust me, we're making decisions in line with that. And I could say that all day, but until I have money in there, or they have money in there, that's very telling in my opinion.
Yeah, and kind of going back just a little bit to one of the other things that you brought up about their track record or their performance, and you have to look at that.
Yeah.
Right. I remember you making an example one time. Do you want Justin James on your team or LeBron James? Right. You want to definitely want to look at those stats of what those operators are doing, so Totally. That it's a good deal.
Who's Justin James?
I don't know who Justin James is.
He's actually a real player. That's the point, though, right?
Yeah.
we want to know.
Exactly.
Now, listen, man, everyone starts, right?
Yeah.
Everyone has to start somewhere. But my opinion, you need to be partnering up with people who are more seasoned when you start. That's what I've done. That's what I teach people to do. Why? Because it's credibility. And number two, you're not going to know it all, man. That is a fact. When people come to my events and they're like, oh, I'm just going to do it on my own. I'm good. It's like, I cannot even imagine having that much pride. Like, I still do not even. I'll never know it all, man. I look back 5 years ago and I'm like, holy shit, I was winging it back then. But I know I'm going to look back 5 years from now and be like, holy shit, I was winging it back then.
Yeah, absolutely. So the first thing is screening, vetting out those operating partners or the managers there. Second thing you said is the investment strategy of the deal or the business plan. Why?
I
guess a better question is, what are you looking for in that business plan and that strategy?
Yeah, I'll answer both, why and what we're looking for, because every investment, every strategy, and I'll go through the different strategies, but every strategy has different pros and cons and different risk levels, right?
Yeah.
So that's it's a huge thing too, man. I want to know what the risk tolerance for when I'm actively investing. I want to know what the risk tolerance of my investors are so I can let them know, is this a good fit for you and what you're looking to accomplish or not? If it's not, dude, I'm going to tell them this is why, right? So I'm going to figure that out too. Every as I'm passively investing, every strategy has different pros, cons, that kind of stuff. So, and everyone has a different idea of what risk is and how much they're comfortable with. So some investors look for the highest returns possible. They're not too concerned with risk. And some syndicators think the same way. So a conservative investor, they focus more on income generation out the gates, right? Those individuals should be investing in higher quality properties with low leverage, or in a fund that is diversified across a bunch of different properties, high-end properties. Those with a bigger appetite for risk, they're going to be, that are more focused on this long-term equity horizon, value add, or maybe even some opportunistic, reposition type deals. We toe the line. Like, I prefer to toe the line on conservative and mildly aggressive, right? So these light value add deals in secondary, tertiary markets, I believe that niche has this, I know for a fact that niche has been able to weather, volatile downturns and also has strong upside. So it has safety, but it also has upside, right?
Yeah. Do you want to get into those specifics at all?
Sure.
Why?
There's 4 basic strategies, okay?
Yeah.
And I won't get into tons of the details, but 4 basic strategies. There's what's called core real estate investments. Core real estate investments. And, anybody who's listening to this who is a passive investor, you should be taking notes. Anybody who's listening as an active investor, you should be listening and taking notes and know how to talk about these things, right? So core real estate investments, that's core. I look at core equals income. So that's best for conservative investors. The annualized returns lower, 7 to 10% annualized returns, right? So that would be an example of that. That would be like a fully leased building in Manhattan that has little to no deferred maintenance. It cash flows out the gate, right? That's a core real estate investment. So you're protecting your downside, but you're definitely limiting your upside there. Okay. Number 2 would be core. It's called core plus real estate investments. Core plus is there's some income, but there's also some growth potential. So this is low to moderate risk, maybe 10 to 12% annualized returns on something like that. So a little bit of an older building, maybe 15, 20 years, is still well occupied, just needs some light upgrades. Number 3 would be, and this is where we typically focus here, this is our bread and butter, which is value add real estate investments. Value add means growth. So that's moderate to high risk, depending on what side you're on. Little to no cash flow. Sometimes it cash flows out the gate, but most of the time there's little to no cash flow at acquisition, but with potential to produce a lot of cash flow and a lot of equity.
That's where that business plan comes in that you were talking about.
Yeah, and that's another aspect of it. Like, what is the business plan? How do they plan on raising the rents? And are those conservative? That kind of stuff. But yeah, value add. What value can we add to the property? And most of our deals, we project 16 to 20%. I expect that for any passive investment that I'm going to look into as well. And then opportunistic or major reposition deals. Those are opportunistic is risky. I would classify that as risky growth. So it's the riskiest of all real estate strategies. There's no cash flow for a couple of years, maybe even more. But there's potential for high amounts later. So that's 20% plus annualized returns on something like that. But it's a riskier deal, right?
Why do you look for the Why do you pay attention to the market, right? Because I know you do. Why is that?
I was trained by Dave Lindahl.
Okay,
you know that.
Yep,
I love Dave. And Dave stressed this, man. He has this book called Emerging Real Estate Markets. And if you've never read that book, people should. It's a great book, man. Emerging Real Estate Markets. And so he trained me to always look at the markets. And it's interesting because I didn't even look at the market on my first passive investment. No. Did I just freaking dove in, man? It's like, whatever. Somebody brought me a deal, I'm ready.
Yeah.
Okay. Now I look at these things, man. I geek out on market stats. So,
yes, you do. You love that stuff. No, you really do.
I do.
But it helps. It helps a ton in the long-term play of whatever the deal is too. For sure. That's what you
risk return type stuff too.
Yeah.
So, the historical 3 to 5 year historical and projected growth. Things like population and income, wage growth.
Where do you find all this information? Is this just because you have access to all this information that's why you use it, or
it's just right here in my dome always, dude.
How do you access that? How do you find that information?
I look at reports all the time.
Okay.
We look at we subscribe to CoStar.
Okay.
CoStar is a little bit spendy. We have a global, national account there, but that hasn't always been the case, man. I'll look at first off, I look at reports all the time. Marcus and Millichap type reports. Every brokerage company puts out reports. But I'm also looking at things like the BLS website and just the tracks job growth and that kind of stuff.
Right.
So, yeah.
What importance does job growth and those type of things play in a deal?
Huge, man. Like job growth brings people to the market. It just does. And also job growth is what provides people and people for our product. That's our product, right? People are the product,
right?
Our customer, I guess you should say.
Yeah.
And then job growth also allows them to have a job to pay rent because we want them to be able to pay rent. So job growth is the biggest key indicator that we look at, and the diversity of job growth as well. That's huge. So
we talked about operating partners.
Yep.
Talked about operating partners first, and then we talked about the investment strategy of the deal.
Yep.
And we talked about the market.
Yep.
And then I want to talk about the story of the deal because you brought up the story of the deal too. Why are they selling? Why is it important for you to look at that the story of why it's up for sale even?
I'm going to mention one more thing before I forget though.
Yeah.
Because I believe that it's one of the most important things with the market. We talk about job growth is important, but I want to know how the employment base, like how diversified it is.
Okay.
Right? We don't want any sector to be more than 18 to 20% of the total employment. So. And the employment base, that should be diversified across different employers as well. So those different sectors and the different employers within those sectors. I believe that's one of the most important aspects of it.
And the importance of that being?
You kind of have like a smirk on your face. What?
No. It's just this is such important information.
You've never heard me use the word sector? Is that a big word? I'm pretty proud of it.
No, dude. I think it's important that you're hammering down on this because, like you're saying, what if there is a job in an area that provides jobs for 80% of the people that are in your building,
and then all of a sudden that company goes upside down. What happens? So it's so important. That's why I'm smirking, dude. It's because maybe it's not something that I've necessarily thought about before. I love it.
Because
what was the story of the deal, though?
Right.
This is, as an active investor, this is my favorite piece to put together, and I believe that this is where I've been on a million different private money presentations, a ton, dude, because I'm always looking for ways to put my money to work. But I like to learn, dude. I like to learn all the time. Like, how are people approaching this? And I believe that this is where most people fail in raising money, which is helping people understand the story of the deal. Like, I love putting this stuff together. Like, what's the seller's motivation behind selling? You know, I'm really trying to understand if that story makes sense. You know, are the current owners, are they burnt out? Are they jaded? In the industry, have they been managing their own property and now they're burnt out and jaded because they manage their own? Or they just want to cash out into bigger properties. People ask me this question all the time in the class, which is like, why don't we just hold a property indefinitely, right, when we're actively? It's because it's very rare that people do that. Like in this market, in this niche, multifamily, we buy, we add value, right? So force the appreciation over a number of years, 3-5 years is average, and then sell. But when we sell, people think that when we sell, we just roll. No. When we sell, we then take that money and we roll over into more deals, right? That's like I would never just want to cash out and keep it in my bank account. That'd make me want to puke.
Right.
I want to put it to work always. So we're always looking at. So anyway, I want to know the story of the deal, I guess is the point, right? So last year, a year ago, we bought Charbonneau. I've been thinking about this property a bunch. It's doing great. But those owners, like the story of the deal, to give this example, those owners had bought it, I think it was 3 years ago. They had a fire right after closing. They skimped on their insurance, which means they weren't able to rebuild that building. They burned down a whole building. Then they were undercapitalized as well. Then the owner that ran the real estate side of their portfolio passed away. And so, dude, they had to sell, right? That story was when I started looking into all the details and what we needed to do and why they were selling and the opportunities that provided us. It was like, oh man, I knew for sure it was a home run. Yeah. So when I'm looking at the story of the deal as a passive investment, it's the same thing, man. What is that? What are they purchasing the property at, and how are they calculating the NOI growth and that kind of stuff?
I want to just point out one thing there too, because you're always talking about making sure to provide value to the people that you're working with. Mm-hmm. And I remember when we were doing Charbonneau, it was a huge relief to them to be selling this property.
Oh, yeah.
So oftentimes when you're understanding that story too, you can build relationships with the seller. Didn't that seller lead to another deal as well?
That one didn't lead to another deal, but that broker relationship that we met there led to multiple deals.
Because we took care of the seller. I remember us being because it wasn't the best situation for them, but it's just constantly feeding those relationships. And I just wanted to point that out.
No, dude, I'm going to harp on one more thing there. because I believe that so many people think that it's win-lose, right?
Right.
It's just not a zero-sum game.
Right.
It's not a zero-sum game. There can be win-win scenarios, period.
And Charbonneau was one of those win-wins for sure.
They had a 10-year term, so a 10-year loan, and we're buying in year 3. They're selling in year 3, which means they're going to pay this huge prepayment penalty. So when you say we took care of the seller, how did we do that? Well, we got creative to find a way to assume their loan, assume the loan so that they didn't have to pay prepayment penalties. But that also allowed us to buy the property for cheaper because we looked past our own selfish needs and desires, those kind of things, looked at ways to make it a win-win, and it was absolutely a win-win. So, yeah.
So I just wanted to point that out. That has a ton to do with business plan. So I wanted just to harp on that just for a second. The next thing that you mentioned was
Did you lower my chair?
I didn't touch your chair.
I feel like you're sitting up higher than I am. Are you trying
I'm working on my posture. I'm sitting up straight. No.
All right, I'm doing it too.
The next thing. Now I'll relax. No, just kidding. The next thing that you talked about, the business plan, you want to make sure that those numbers hit, the underwriting.
So business plan is different than underwriting. I do want to know what they've underwritten the projections at.
Yeah.
But the business plan is different. This strategy that they're looking to do, does it work in that submarket? An example of that, let's say that they're trying to turn Class C properties, do a value add or a heavy value add on Class C properties in some affluent zip codes.
Yeah, right.
They're going to have a hard time doing that. Like I think of, we have properties in Dallas and Houston. I think of Highland Park in Dallas, and I think of River Oaks in Houston. That strategy is going to be tough within that submarket. So matching the strategy to the submarket, I believe that's key. I want to know what that is.
Right.
What's their hold period? A typical Class B, C value add multifamily strategy I mentioned is between 3 to 5 years. What's their hold period? And is that in line with their loan term? And what is the loan term? We'll get into that stuff too. I also want to look at comparable properties. So let's say that their plan is to go in and they want to renovate some of the interiors, bump the rents to X amount. Well, I want to see a comparable property in that market where that strategy is, that's post renovation, where that's been done,
effective,
successful.
Yeah.
It really helps prove that this proposed strategy that they're putting into play, or that they're wanting to put into play, is applicable in real life, right?
Right.
So, and also, what are their post renovation rents based on? Is that just total speculation? Or are they looking at true competitors? Like when we come to a market, I want to look at those individuals who are achieving top rents. I want to know what their interiors look like. I want to know what they're doing, what amenities they have, what are they doing, right? And then, we're going to follow suit. We're going to follow suit. I'm not trying to reinvent the wheel, man. We're not trying to reinvent the wheel. We're going to come in. I want to be priced rent-wise right underneath them. That'll allow us to maximize rents, but also maintain occupancy, be super competitive.
Dude, I think all of these things are so important, whether you're an active investor or a passive investor. Because if you're an active investor, you need to know the answers to these questions that Ty's asking.
Oh, yeah.
These things that Ty's talking about, you need to know those things. So when your passive investors come and ask you these things, you can talk to them easily.
So now ask me how I learned this. You ready?
Yeah. How did you learn
I
it?
passively invest in a deal, garbage, right? So I'm thinking, man, I need to ask better questions, do better research, whatever. And then I'm obviously active. The money that I make actively investing all goes back into passively investing. That's all just rolls back over.
Right.
So now I'm actively investing and putting a deal together, and I get on a call with a gentleman. He's from Florida, and I won't say his name on here, but he grilled my ass with so many questions. This is in the beginning, right?
Yeah.
Grilled my ass with so many questions. I was literally writing down, I have no idea the answer to that question. No idea the answer to that. These are great questions. I say this, writing it out with my hands, but really I'm typing it out because I don't write shit. Writer's cramp. Typing it out. And dude, this person was farther in the game than I am, right? I didn't try to pretend like I knew it all. I was grateful that he was asking me questions that I didn't know the answer to, because I was like, bro, these are great questions, man. First off, I'm going to go get you the answers to these questions to let you know that I'm serious about that.
Yeah.
Second, that's valuable to me, man. Thank you. Now I can make better passive investments, and I can be better at the active side, all the above. So
keeping those things in mind. For sure, when you're talking with your investors, that it's never a lot of the times when investors are asking you these questions, they're not trying to challenge you.
No,
they're not trying to put you down.
Yeah,
because I feel like a lot of times some people get defensive when these questions start coming from investors.
Yep.
It's not that.
How you can challenge me? Of course, I've done my research.
Right. But you should be grateful. And if you don't know, I think one of the biggest things that you're saying right here that we kind of just grazed right over is you wrote down all of those questions, you went and found out the answers, and then you came back to give him the answers, and that's huge.
Speed of execution, man. My job isn't to know it all. I'll never know it all. My job is to continue to learn so that I can make better passive investments for me and my family, and I can continue to make better active investments for me and my family and for my investors and their families. Like, that's a big responsibility, man. Like, it's a big deal.
It is, for sure. Okay, awesome. We talked about all these things, and the very last one that you mentioned was underwriting. So I want to just touch on that really quick before we wrap up here. Underwriting.
Okay, so
what do you look at there?
Underwriting is what makes my brain turn into mush. Numbers and spreadsheet. I mean, dude, it's not I don't love it.
Yeah.
But you have to know it, dude.
Right.
You have to know it. So this is where Ryan Woolley comes into play. I'm so grateful for him as a partner because he's a great underwriter. He's taught me a ton on underwriting. And then we've taught each other about underwriting and this is like income, expenses, profit and loss statements, all this kind of stuff to be able to truly understand where the property's at currently, but then to also look at what's conservative and what's very aggressive. In the beginning, if I'm being honest, when I was doing my projections, I didn't know what was conservative and aggressive because I'd never done a deal, right? It was my first deal. So how did I learn that? Well, I got mentors, I got coaches, I got partners, I learn all the time learning. So I want to look at the revenue. How does their year one pro forma, this is key. How does their year one pro forma compare with the trailing trend report? We call it a T12. It's the last 12 months, right? So how does that look? Where it's at currently compared to where they project to be in a year, is that super conservative? Is that just what does it look like? And check their assumptions. Okay, so if anybody's listening to this and want to take some notes, here's the assumptions that I'm looking at. I'm looking at loss to lease, how quickly they're going to recapture it, which is loss to lease is how far below market rents you are. And when you start to raise your rents to recapture loss to lease, your vacancy should increase because as you're raising rents, people will naturally vacate, and that's okay. I just want to make sure on the projections that as rents go up, vacancy goes down a little bit, right? That's conservative. I want to know concessions. Are they offering concessions? Are they planning to offer concessions? Do they offer concessions? We very, 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 very rarely offer concessions. That's part of choosing your market wisely. Employee units. Is there employee units there? I'm going to look at bad debt. Is there bad debt for any reason? And then other exit assumptions, like my return assumptions or projections I can talk about too. But exit cap rate's very important. I know I'm just kind of rambling, but expenses, I'm going to look at the same thing. How does it compare to the pro forma compared with the current data? I want to know how does their expenses, how does that grow over the whole period? You think of inflation. So I'll look at this, okay? So I'll look at the expenses, and I want to look, have they accounted for inflation each year? And are they conservative with their inflation, or are they aggressive? Like, do you know what the average inflation is each year?
It's somewhere in between 3 to 6%, I think. Am I wrong?
Usually 2, 3. Okay, but this year, dude, it's 5, 6.
Yeah.
So I want to know, and we usually project in the 4 or 5 range.
Right.
Why? We want to be conservative investors. So I want to see if they've done the same thing. Their debt. I want to know what kind of debt. Debt plays a huge role in these deals. So what kind of debt have they put in place? What's the amortization period, the loan term, the interest rate? Is there any interest-only periods? What's their loan to value? That's huge too. Leverage is great, but being over-leveraged is not great. So what's their debt projections, and are those true quotes, or are they just assumptions? Are they just assumptions, hey, this is where I think it will be, or are they real quotes that they've got from their lending broker or somebody like that?
And you need those real numbers.
And real numbers for sure. And then lastly is that I think is probably one of the most important too is the sales assumptions, like as we're exiting a property. One of the ways that people can skew their projected return numbers is the exit cap rate. So anybody passively investing, you should write that down, highlight it, circle it, whatever. But the exit cap rate, to be conservative, that exit cap rate should be higher than the entry cap rate. So if we're buying at a 5% cap rate, then when we exit, my cap rate is going to be higher than 5, usually 50 to 200 basis points higher than the purchase cap rate. And then what are the selling costs as we exit, right? And the last thing that I'll mention, and then I'll let you wrap it up.
This is all. No, dude, this is good stuff.
I know it's good stuff.
Yeah,
I just know that sometimes when we talk about these things, it makes people's eyes blur over, which is why I said in the very beginning that I'm going to give you this deal screening checklist guide, because that's helped me a ton. I know it'll help you a ton. It'll be in the show notes. Download it, read through this, learn it, understand it, get familiar with it, all that kind of stuff. So last thing is just the return analysis, like how are the profits split up between the passive investors and the operating partners, and how quickly is the property going to start cash flowing. So
these are all so important things. I wanted you to kind of go off on a couple of these tangents on a couple of these things, because Tyler is a very successful passive investor. And this is how he does it. I only know that he's a very successful investor because I got the mail and I indeed saw the check that he got. So I'm very aware. So if you aren't sure how to invest, this episode very well shows you how to do that successfully and the things you need to be looking at. So Tyler, thank you so much for sharing. You almost kind of shared all your tips and tricks on how you invest. So this is a very, very, very valuable episode for those that may not know how.
High level, though, too. As deep as you think it is, that's high level. So once again, though, man, the deal screening guide will
for sure.
You'll see how detailed it gets. And I want to clarify, I don't need to get all those details on every single deal. Like, I'm going to grab the ones that are most important, but I know what's most important, right? That's key.
Awesome. We usually end Aloha Friday with a Aloha value.
Love it.
Or a Hawaiian value. What's going to be the one today?
We're going to do the one that I shared in the Maui meeting. So each first Wednesday of the month, we do a Maui meeting for the company, all the employees, everybody that's involved. And it was, do you remember what it was?
Po'okela.
Po'okela.
Did I say it right? Did I say it right?
I think so. Shit, I don't know.
It's
Po'okela.
Is it strength? Courage?
Strive for excellence.
Strive for excellence. Sorry.
Jackson.
I wrote it down. It's in my notes.
Yeah, right.
I just didn't remember.
Yeah, right.
I'll show you after.
Strive for excellence in everything that we do, like never getting complacent, never getting comfortable. And I'll tell you the experience I just had that I haven't told you.
Yeah.
I just went to deposit that check.
Yeah.
And so on the call, I talk about never being complacent, never getting comfortable. And I talked about how I've been laid off. Like back in the day, I got laid off 2 different times during Christmas holiday. That is ultimately, I believe that's ultimately what changed my life, dude, because that created this freaking urgency to make sure that I was never in that weak position again. Like that I was in control of my life,
Yeah.
And I never got comfortable. It's because I got comfortable. And these small little changes led to big results. And so right after I talk about this on the training, I go to deposit this check and can't deposit it at the ATM. It's too big. I go inside and the lady asked me to fill out a deposit slip, and there wasn't enough spaces on the deposit slip for the number of the check. And that might rub people the wrong way, but I'm telling you that because I can't tell you the amount of gratitude that had. I mean, I was just very grateful for how different my life is, from even a couple of years ago. And that's because people introduced me to this space. And I'm very grateful for that. I had mentors who pushed me, who believed in me, and I'm grateful. So strive for excellence.
No, dude, thank you for sharing that. I think it's huge to notice that, because you weren't there a couple of years ago. And now just over time and you working and continually to work at it, and all of the things you talk about on the Growthcast, all of those mindset principles that Dallas talks on the daily drips as well, you've implemented those things.
Yeah.
You were doing those things.
Every day.
And I know that you credit a lot of your success or that check that you got to those things.
No question.
So just another reminder, another actionable. Dude, these things that Dallas and Tyler talk about on the Growthcast, put them into play, put them into effect, and live those values. I have, and it's been a short time. It's been like a year that I've been, and my life has changed dramatically.
I've seen it. It's been awesome.
And it's been awesome. So just another reminder, actionable, call to action. Listen to these episodes daily and put into effect. That's not even what I'm trying to say. But use those values and do the things that they suggest to do.
Knowledge without execution is useless.
Yeah, right? Execute on those things for sure.
I
awesome. Tyler,
hey,
thank you, sir.
Thank you, bro.
I appreciate you.
Thank you to all the listeners out there. We love y'all. Have a great weekend with families, friends, whoever, and we'll see you next time.